everyone. And I'm pleased to have this opportunity to share my experience in the EPC contract and together with international finance. As we know that every infrastructure project, particularly large infrastructure project with very much investment, normally involves in international financial institutes to provide the finance for the project. And under such a situation, there would be a different model of finance, such as buyer's credit, seller's credit, and project finance, or even as Ms. Liu just mentioned, deferred payment and TB, build and transfer, BT, so on. But normally, for buyer's credit is from time to time very much used in large infrastructure projects. Then buyer's credit means that the borrower would be the owner or promoter of the project. And the lender is an international financing institute. Then why the lender provides such money, such a large amount of money for the project, because they can earn some interest and also support infrastructure construction. Under such a situation, the kernel player of such a project is the bank. The bank will assess whether the project is bankable, and the bank will consider the risks to provide such loan. So the bank normally will ask some financial institution such as insurance company. In China, we call it Sinosure. It's called China Export Credit Insurance Company. China Export Insurance Company. And to provide guarantee. But why the insurance company can provide such guarantee? Normally, the insurance company get counter guarantee from the project government, the government of the project. So today, I'd like to talk from insurance point of view and together with bank's point of view, why they can provide the fund, what elements each party should consider for such project. I must say that the PPT have some guidelines, but normally I talk just according to my experience. This project is just finished one, Patma Bridge Rail Link project in Bangladesh. And it's just give you an example. It's a EPC contractor, it's China Railway Group Limited. And the source of fund is 85% of buyer's credit from Export-Import Bank of China, and 15% of the government of the People's Republic of Bangladesh. And it means that the project company. And so this just example show you that we have done and just finished such a project overseas. So from the insurance company's point of view, the following elements should be concerned. One is buyers related risks. As we know that insurance company and financial institutes, to involve any project, they most concerned of the risks, whether they can control the risks, whether the risks is under the control or under the prediction. So under such a situation, under such a situation, from first I talk from the insurance company's point of view, they mostly concerned from the following elements. Buyer-related risks. Buyer-related risks means that the borrower means the borrower of the project, who borrowed the money from financial institute. First, they need to consider creditworthiness. Creditworthiness means of the borrower, which means financial stability, whether they have financial. The credit insurance company will closely examine the buyer's financial statement and includes the assessment buyer's liquidity, solvency, and profitability. For subway project, buyer with strong balance sheet, low debt to equity ratio, and consistent cash flows is more likely to be able to serve the loan. For example, if the buyer is a government-owned urban transit authority, its financial stability may be influenced by the local government's budget allocation, fair revenues, and potential subsidiaries. The second creditworthiness element, the second one is about credit history. The track record of timely debt repayment is crucial. Any past defaults or late payments on other loans can significantly increase the risk of perception. If the buyer has a history of defaulting infrastructure-related loans, the credit insurance company may be reluctant to provide coverage or will change to a higher premium because the insurance company need to cover the risks. This is to concern about the creditworthiness of the borrower. Second one is concerning about the operational competence, project management skill. First, the buyer should have in line with experience or ability to hire competent project managers to oversee this subway project. Subway construction is complex, involving many disciplines such as civil engineering, electronic engineering, and urban planning, and also environment assessment, and technical, tube tunneling, signaling, station, civil work, so much work. So this point, they must consider who would be the contractor, who would be the engineer, who would be the provider of facility, equipment, we call it procurement, vendor. So these things very much heavily on EPC contractor. So the both insurance company and the financial institute are very much concerned who will do the EPC contract work, who will do the engineering, who will do the civil work, what would be the procurement, where the procurement comes from. Because when the bank provides the loan, they are very much to concern about the revenue turnout after completion of the work. So this is called management. Also, industrial experience. Experience in the transportation and the infrastructure sector is an advantage. If the buyer has such experience, it will have a plus in the finance elements. Second one, concerning about the project risks. Concerning the project itself, we call it specific risks. First one is technical feasibility. Both the bank and the insurance company very much concerned about the technical feasibility. Technical feasibility covers two areas. One is geological and environmental challenges. Second one is technological complexity. For geological and environmental challenges, subway projects are highly depends on the local geological condition. if the construction site has unstable soil, high groundwater level, or it is in an earthquake-prone area, it can pose significant technical challenges. For example, tunneling through soft soil may require specialized construction technique and facility, and failure to address such issue can lead to construction delays or even project failure. The credit insurance company will assess whether the project has accounted these risks in the design and construction plan. Second one is technological complexity. The use of advanced technologies such as automated train system, energy, or efficient infrastructure can add to the project complexity. While these technologies may offer long-term benefit, they also, yeah, sorry, let me, yeah. They also carry risks of integration issues, higher maintenance cost, and potential technological obsolescence. Next one is concern, both bank and insurance company concern is about economic viability, ridership projection. Success of subway project in terms of loan repayment often hinders inaccurate ridership forecasts. The credit insurance company will review the methodology used to estimate ridership, considering factors such as population growth, urban development. These elements just for the turnout. Also, the next one, economic viability, will cover the cost benefits analysis, we called. The comprehensive cost-benefit analysis of the subway project is essential. It includes not only consortium construction costs, but also the long-term operation and maintenance cost. Because at the very beginning of the operation, the turnout revenue and the balance sheet of the revenue is not so good. So they must consider the cost and the balance of the income and expenditure in the future, in the near future. The third one is external risks, which most of the insurance company, most of the items that insurance company want to cover or to concern. Number one is political and regulatory risks. Political changes. Political risk and regulatory risk covers political changes. Government policy regarding urban planning, transportation, and infrastructure financing can have a significant impact on the subway project. Second one is regulatory approval. Subway projects require numerous regulatory approval. From environmental clearance to construction permits, delay in obtaining these approvals can cause project delay and cost overruns. The credit insurance company will consider the regulatory environment and efficiency of the approval process. Next one is market risk. The interest rate fluctuation, including the interest rate, exchange rate. The interest rate and fluctuation, since the buyer credit loan is likely to have a long-term, very long-term financing arrangement, interest rate in fluctuation can have a substantial impact on the loan repayment burden. If the loan has a variable interest rate, an increase in market interest rate could significantly increase the buyer's debt serving costs. The credit insurance company may analyze the interest rate environment and the buyer's ability to manage the interest rate risks. The next one is exchange rate risks. If the loan is in the foreign currency, exchange rate fluctuation can pose risks. For example, if the local currency of the buyer depreciation against the currency of the loan, the cost of the repayment of local currency term will increase. So under such a situation, of course, there are many other risks, such as the risk of the smoothly EPC contractor can finish the work, and whether there would be occur or any hurdle during the EPC construction during the construction period. So under such a situation, FIDIC Silver Book number 20.4 listed out there would be DAB or DAAB mechanism during the construction period to prevent any disagreement become a dispute. Because of the time limits, I have to stop at here, but my point of view is from the point of view of the insurance company and the point of view of the International Financial Institute to check whether any project is bankable. And also, the insurance company provide credit insurance has a condition precedent is the government or secondary guarantee government, such as Honai city government or Ho Chi Minh city government can provide counter guarantee to the insurance company, Sinosure, to cover any risks, because this part of the counter guarantee can control or mitigate the risk of the political risks and some of the economic and financial risks. I have to stop here. If you have any question, and at the end of the seminar, we will still have time for question and answer. Hope that this kind of speech can give you some arising or understanding of such EPC plus financing project, because other form is not normally used. Normally use EPC plus buyer's credit is normally used. It's a very much time-saving method. Thank you very much.
Thank you very much, Mr. Nance, for a very